Financial markets were shaken last week as Silicon Valley Bank, the California bank subsidiary of SVB Financial Group, fell into FDIC receivership. SVB is the first FDIC-insured institution to fail since the year 2020 and the largest by assets since Washington Mutual failed back in 2008. The bank held more than $200 billion in assets. SVB's failure was then followed by another over the weekend, cryptocurrency-focused Signature Bank. The news, not surprisingly, caused market participants to speculate whether there would be another shoe to drop, so to speak. For some, these developments have brought back some painful memories of the financial crisis 15 years ago. Now, before explaining what happened, let me first start with the most recent headlines that we all saw. Well, Sunday night, we received word that the U.S. government would step in to prevent contagion, or another fancy word for contamination, by offering SVB customers access to their uninsured deposits. Now remember, deposits in banks are insured up to $250,000 per individual account. And by designating SVB as a systemic risk to the banking system, the Federal Reserve and the U.S. Treasury Department are able to use emergency lending authority measures to prevent runs on other banks. The top priority in this situation was to prevent, again, runs on other banks, especially the many small and mid-sized banks that are not under the watchful eye of the Fed and not subject to some of the more sophisticated compliance stress testing measures. So how does this compare to 2008? Well, back then, the problem was far-reaching credit risk, substandard mortgages on virtually every financial institution's balance sheet, and the balance sheets of many non-financial institutions as well. Now, credit risk is not the problem this time. It is interest rate risk. As we know, the value of a bond and interest rates have an inverse relationship. In this case, rising interest rates caused the value of the bonds on SVB's balance sheet to lose value, and therefore the bank was not as capitalized as it should have been. Its heavy exposure to interest rate sensitive Treasury and other government securities with insufficient interest rate hedging activities left the bank especially vulnerable to a run. But that's not the whole story. SVB's niche customer base was another big problem for the bank. You see, the bank did not have the normal retail banking relationship as we consumers have with our banks. Its emphasis was on early stage venture capital customers, which meant its deposit base was much more concentrated and less stable than a normal retail banking relationship. Once the bank was known to be facing solvency issues, word travels fast through the venture capital community, and the deposits fled as fast as entrepreneurs could log into their accounts. With the federal backstop now in place and few, if any, other large banks facing similar interest rate risk, any further spillover should be limited. One footnote, however, during the recording of this video, the Wall Street Journal has posted a headline about potential troubles at European bank Credit Suisse. So what should investors do? Well, first of all, for longer-term strategic investors with well-balanced allocations, we would not make any changes at this point. This does not appear to be another 2008. However, there are some precautions you can take. Deposits in banks are insured up to $250,000 per individual account, and $500,000 per joint account per bank. A couple may qualify for up to $1 million in insurance if they each have an individual account and share a joint account. Any custodial accounts that they have for their children would qualify for the additional coverage as well. In this most recent case with SVB, the federal authorities have guaranteed all deposits at SVB, including those more than the $250,000 limit. Now, keep in mind, U.S. Treasury securities are backed by the full faith and credit of the federal government and can be a low-risk alternative to traditional savings accounts. Deposits in brokerage firms are protected by the Securities Investor Protection Corporation, or SIPC, which protects against the loss of cash and other securities. Protection is up to $500,000, including $250,000 for cash per account type. Different account types include individual accounts, joint accounts, Roth IRAs, estate accounts, and custodial accounts. Remember, we are referring to the cash that are in these types of accounts. So these defaults appear to be, again, isolated in nature. Realize that all banks must manage their balance sheet very prudently, and it appears that SVB did not do that. Their portfolio of bond investments was too long in duration or maturity, and when interest rates rose dramatically, the value of those bonds fell. Most of their portfolio then was underwater, and they had to sell at a loss to meet customer withdrawals. Again, we do not see this as another 2008. So if you have any further questions about this most recent current event or anything else, please don't hesitate to call the office. And once again, thanks very much for listening, and take care.